I was asked to tell everybody to first turn off your phones and Blackberries and all. So apparently the equipment is very sensitive to pick anything up. All right, so as John said, I'm going to do kind of an overview of a subset of issues in banking pertaining to bank capital, financial fragility, and financial stability. And it's more of a sort of an overarching thing as opposed to talking about a specific paper. And so, but at the same time, I want to do this in a normal seminar style format, so feel free to interrupt, ask questions, present thoughts, whatever. So even if I don't pause, because sometimes I'll get all excited and keep rolling and just stop. So, all right. So one of the advantages of being an organic profession, I was just talking to Chester there. There are a few of us around from that era. Is that you can actually go back in history and think about what the world was like before it changed. And I still remember when I was working on issues in banking research back in the 80s. Very few of us working in the area, and even fewer working on issues related to theory. Much of the work that had been done was pretty institutional. There was empirical work that was being done, but there were really very few banking sessions at major conferences. And I remember going every year to WFA and AFA, and maybe a couple of sessions on banking. Journal of Financial Intermediation was launched in 1990, basically, to stimulate and consolidate banking research. And we saw very few job market papers that were in banking. So this was sort of what the world looked like. Remember, we would always complain about how few banking sessions there were and, at the major conferences, even relative to the research output that was out there. And then, of course, as you all know, this changed quite dramatically. And if you think about the world of finance in the last 15 years or so, Franklin Allen and Mark Flannery created the Financial Intermediation Research Society, before all the real excitement in banking came into existence. And part of the purpose of this was to actually bring together those of us who are working in banking for these annual conferences. And the idea was to kind of span 3 continents, Europe, Asia, and North America. And so these are all the places where we went for conferences. So if you are interested in going to places in the world that you haven't been to before and have a good time like you're having here in Vegas, the next one is in Hong Kong. It may not be as exotic as some of these other locations, but still. And now, of course, we have a growing number of banking sessions at all the major conferences, growing number of banking publications in the top economic journals. The other interesting thing is that I would say that the past few years since, I would say 06, 05, 06, more than 50% of the empirical corporate job market papers that we see are in banking in some way, shape, or form, or at least financial intermediation, broadly construed. So you've got senior economists, two Nobel Prize winners who have been working in this area for quite some time. At MIT, their PhD macro sequence, the third course of the sequence, is basically entirely on financial crisis. So certainly a lot of things have changed. And we recently had, so the last bullet point is an interesting anecdote. We were reviewing somebody for tenure, and one of the things that we look at is citations impact. And you do a peer comparison with other people from the cohort, or roughly speaking, that cohort. And this person fell, I would say, somewhere in the middle cohort. And everybody, of course, wants people in the top X%. And I made the point, looking at that cohort, that this was an exceptionally tough cohort to compete with. And after the meeting, nobody pushed back on that. During the meeting, you see from the citation numbers, it was a very tough cohort to compete with. And then after the meeting, one of my economics colleagues came to me and he said, was this just random chance that these people were also highly cited, or was there something that happened? And I'd never really thought about this seriously before, but I said, a lot of the people who are on this list are actually doing research in banking, maybe if you empirical. And this has been one of the actually better represented areas in finance in the last few years. And not only were they successful in publishing, but these papers also ended up being pretty highly cited. So this was sort of a tough group to compete with in terms of peer comparisons. So the question is, what changed, right? And what's the moral of the story? Okay. You would interpret this as a rhetorical question, but I was actually expecting it. But the first question, the answer to the first question is obvious. That what changed, of course, was the financial crisis. And I think the moral of this, I think it was Winston Churchill who first said, never let good crisis go to waste. And I think certainly the financial profession, while we all suffered a hit to our net worth because of the crisis, I think we're all richer because of all the ideas that came forward, the new databases. It was both a supply and demand story, right? You had a lot of people interested in working on these topics because they had access to new data that we hadn't seen before. There were a lot more interesting questions. We weren't doing, the 10,000th paper on, agency costs and capital structure. And so there were new, fresh questions. And then there was also a demand. So there was a supply, and the demand was, hey, we were interested, the top econ and finance journals were very receptive to these new papers and new ideas. And it gave birth to a whole generation of really bright stars in the profession. So, I think in that sense, the crisis was just a terrific boom to research. So I'll give you a brief outline of the session. So I want to talk about, especially focus on the role of bank capital in financial crisis and financial stability. I'm going to link it back to our theories of why banks exist, what services they provide. I'll talk about some empirical evidence, and then goal is to end with open questions that we don't quite know the answers to. Now, it's very interesting. We have this very rich tradition of really good work that's been done in capital structure for non-financial firms, right? Both theoretical and empirical. And it's kind of interesting in many of these studies, it's sort of standard practice to just exclude financials because banks are somehow very special if you do empirical work. That's pretty common. Most of the theoretical work really also focuses on non-financial firms. So that part of the literature is really well developed, but when you look at what's been done in capital structure and banking, that literature is still in its infancy. I still remember reading a paper by Merton Miller published in, I think, 1995, in which the title of the paper was, Do the Eminent Theorems Apply to Banking? 1995. It's pretty surprising that that was sort of still an open question in Miller's mind. And I would argue that bank capital structure is a much more important issue, simply because we can't just rely on the fact that banks have a privately optimal capital structure, and we'll understand what the factors are. The trade-offs will be done with that like we do for non-financials. We have all sorts of issues like safety nets, risk distortions that lead to increased systemic risk, financial stability. So individual capital structure decisions of banks actually have macro implications, have systemic risk implications, spillover, social externalities, and so on. So for that reason, it's surprising, but it's at the same time not that surprising because this work is hard. And it's actually harder than doing this for non-financials because when you do capital structure model for a non-financial firm, you don't have to first also develop an internal theory of why the firm exists. You take that as a given, right? But when you're doing banking, there's such a deep connection between why the bank exists and what its capital structure is, that it's sometimes unavoidable that you have to deal with the existence issue as well, which then, of course, makes the whole exercise much more complicated. Now, we know there's been extensive research done that shows that bank capital has all sorts of effects. It affects bank asset portfolio choices, it affects the default risk, quality of bank assets via screening and post-lending monitoring. It affects the probability of individual bank failures, the probability of correlations between bank asset portfolios, so systemic risk, real output unemployment. So it's of central importance for issues related to financial stability. And so, of course, no wonder that we've had so much attention in bank regulation devoted, prudential regulation especially, devoted to bank capital. And by the way, the whole issue of how the originate to distribute model and securitization has led to the dilution of screening incentives, we now have empirical evidence that that problem is actually attenuated if the bank has more capital. So there's a paper by Amitosh Purnananda in the RFS that makes that clear. So financial stability is of course of great interest to us because financial crises have significant real effects. And I'll just run through some of the things that people have documented. So there's a Federal Reserve Bank of Dallas paper by Luttrell et al. Where they estimate what the cost of this crisis was for the US. And they estimated it was 40 to 90% of 1 year's GDP measured as of 07 GDP. And so that's $6 to $14 trillion. And if you include human capital present value, future wage income, it's even higher. Now, we had the S&L crisis back in the 1980s. And I remember at the time that we went through that crisis, people thought that the cost imposed on taxpayers was staggering. That was like less than $150 billion, right? And we spent almost that much on the AIG alone. So it kind of puts everything in a very different perspective. The crisis, obviously, so there have been 2 or 3 strands of research that have been stimulated by this. One is people have looked at credit supply effects. So, did the crisis lead to a reduction in credit supply by banks because of negative shocks to equity capital because of losses on assets? And this is a very interesting empirical question because empirically, as you know, it's notoriously hard to disentangle supply and demand effects. So you have to be really clever in the identification, and a lot of these papers have provided evidence that is very careful about the identification issues. There's a very nice paper by Anjan and co-authors, and John has a paper on a survey of CFOs in 39 countries, which also supports this notion that the very significant credit supply effects because banks actually cut back on lending. And then, of course, we have extensive documentation that there are demand effects. So if you've read the interesting book House of Debt by Mian and Sufi, there they talk about a very different channel, right? So they focus on the demand channel, and a lot of their research is focused on that, which is, look, we had home equity prices fall as a result of that. Home prices fall as a result of that. Consumers experienced a decline in their net worth. Because of that, they borrowed less and they spent less, and because spending fell, corporations were able to sell less. Because they sold less, they reduced employment, and therefore consumer leverage and the impact of the prices of that was the main driver. So they focus on sort of the demand channel for why we had this increase in unemployment. But I think if you look at the evidence, it seems pretty clear to me at least that you have both supply and demand effects going on. And we have empirical evidence that sort of teases out one effect from the other and establishes each one. All right, so let me just stop here, catch my breath, see if anybody has any questions or comments. Yeah.
Is there work on the credit supply in terms of banks adjusting their portfolios in the face of the financial crisis? And do we think that banks have sort of stuck stable long-term portfolios, mix of loan types and that sort of thing?
Yeah, so there are actually a number of papers that have looked at kind of the micro aspect of that, and what happened in the bank portfolios. So I'll rattle off a few that come to my mind right away. So there is evidence that, for example, banks, and this is to small businesses, that there was a higher incidence of banks reneging on lines of credit loan during the crisis. So certainly there was a small business lending component. Certainly lending against home equity and lending, mortgage lending to consumers did decline. Okay, so we know that that's true. There's also evidence that lending to businesses declined, which is kind of consistent with the demand story also in Anjan and Sufi, that corporations probably had a lower demand. But there's no doubt, and the survey evidence that John in Canada was presented is also consistent with that, that you had CFOs basically saying that they experienced reduced supply of credit. So I think if you look at the sort of the entire body of papers, it was pretty across the board, right, in terms of the impact on credit supply. Okay.
Is there any evidence on the price side of that equation? So you're seeing everything on the quantity side, supply and demand. I mean, both curves are shifting now.
Yeah. Price meaning did the price
I haven't
of...
seen much, I don't know. So in terms of
Yeah.
the price of credit.
I don't recall. I mean, we know just anecdotally that during the crisis, the price of credit went up for corporations, both in the depository financial sector as well as in shadow banking, right? So there's the Gorton metric papers which document that haircuts on repos went from 0% in 07 to about a year to 45% in 08, right? Late 08. So to me, that's a reflection of a higher cost of credit, right? I mean, you could look at that both as a price effect and a quantity effect. It's a quantity effect from the standpoint of a given stock of collateral. Obviously, my borrowing capacity has gone down in repo transactions. But to the extent that it's more costly to replace that with some other source of funding, it's also an implied price effect. All right. And then, of course, a lot of evidence that it affected corporate investment, led to higher unemployment, and there's a causal link between this reduction in credit supply and increase in unemployment. So I find it interesting that this is one of these unusual settings in which you can document with very careful identification both demand and supply effects in the credit market. And that's why this was so interesting. Now, there's a lot of evidence that high leverage in banking and high leverage among consumers were both major factors that contributed to a sustained crisis. So this is taken from my paper review of corporate finance studies. So, you had a bunch of external factors that people have discussed that made a contribution to the crisis, that led to the housing price bubble. A very interesting paper by Taylor and Williams, where they document that they look at different countries in Europe and the US. They basically established that the countries that had the largest deviations in monetary policy from the Taylor rule had the biggest housing price bubbles and had the biggest post-crisis housing price crash. So that was certainly a big factor in the crash of house prices. You had leverage in consumption, so you had high bank and consumer leverage, and you had this enormous growth in consumption that occurred prior to the crisis, and I'll show you a graph that's pretty dramatic on this. We had risky lending by banks, a lot of evidence that lending standards became substantially more lax prior to the crisis. Mortgages got risky, we had the housing price bubble burst. Liquidity shrank. There's a very interesting question about the extent to which this was a liquidity crisis versus an insolvency crisis. We're still arguing about this. And then, of course, we had the full-blown crisis. So leverage was a huge issue, right? So this is taken from my paper with Anjan and Thakor and the JFI, where we lump commercial banks and investment banks together. Just a simple graph of how much the leverage increased between roughly '03 and '06, '07, '08. And then, of course, after the crisis, you had a decline in leverage. What's really interesting to me is that at the same time that bank leverage was going up, household leverage was also going up. So you had this problem of sort of two factors that were working together to increase fragility of the system, right? Levered households and levered banks. Interestingly, you didn't see the same pattern for non-financial corporations, which is the dotted line here. So it wasn't like, everybody was going on a leverage binge. It was really two specific sectors of the economy. It was the households and it was banking. And this correlation, we argue, really exacerbated the problem. And then, if you look at house prices, they were very highly correlated with the increase in leverage. Right? So all of this, there's a lot of endogeneity in that the housing price bubble supported by the higher leverage, but the higher leverage supported by higher housing prices, right? At least at the consumer level. And there's a nice paper by Ravi Jagannathan and co-authors in which they looked at consumption. So they looked at household consumption financed by household debt. And Anjan and Sufi have argued that much of this initial consumption was financed by increased borrowing. And that this was a factor. And they document that excess consumption, which is consumption minus wages, grew by 230% in 7 years. Okay? So these are people who are effectively borrowing against home equity to consume more. They're buying boats and taking vacations. And actually, what Anjan and Sufi showed us that they weren't using the borrowing to pay down credit card debt. They're actually using the borrowing to just consume more. Right? So these were a lot of the factors. So basically, we had high consumer leverage and high bank leverage that created what I refer to as the perfect storm for this crisis. There's a nice paper by Gauthier and co-authors, which uses a structural model. They calibrate it using banking data, and they show that if in fact you use a properly designed capital requirement, you can reduce the probability of a systemic crisis by 25%. So this is not, the crisis triggers are not all completely exogenous. That many of them are really driven by the combined exogenous effect of leverage choices that banks are making in the economy. So systemic risk, and this was, I think, one of the more interesting revelations coming out of this crisis, is systemic risk is not exogenous. Systemic risk, whether it's the Fari, Jerome, AER paper, where theoretically they show how individual bank decisions can endogenously create systemic risk, or it's structural models like this that establish this. I think we understand now that systemic risk is in fact endogenous, and it depends on the portfolio choices banks make and the leverage decisions that they make. There's a working paper, which I like quite a bit, by Shivada Bhattacharya and Amitash Purnanand in Michigan, which documents that during 2000 to 2006, if you just looked at the banking sector, systematic risk doubled and idiosyncratic risk was cut in half. So you could see what was going on in banking was not only an increase in leverage, but also a significantly higher correlation in asset portfolios. Okay? So you're increasing systematic risk, and you're making the banking system more interconnected and more susceptible to sort of idiosyncratic shocks becoming systematic shocks. And then there are a bunch of theoretical papers, Acharya and Yoromazar paper, like I said, Fari's role, but they talk about the incentives that banks have to actually make their asset portfolios correlated. Basic argument is, look, if I make an uncorrelated asset portfolio choice and I fail, it's pretty easy for regulators to just let me fail, right? But if I make a correlated asset portfolio choice, then I'm going to fail in states of the world in which a lot of other banks are going to fail. And then you have this phenomenon called too many to fail, which is there's no way that regulators are going to allow everybody to fail, and so I get rescued along the crowd. So you get these safety net distortions that induce this sort of perverse behavior to correlate asset choices. All right, let me pause, catch my breath. Questions, comments? Yeah.
Could you speak to the increasing leverage in the shadow banking sector leading up to this?
Right. So in fact, when we looked at this data that I showed you here, we were looking at both commercial banks and investment banks together. Okay. And so you had an increase in commercial banking that was actually a little bit less pronounced than an increase in leverage among IBanks, right? Which were, of course, important players in shadow banking. You can look at, if you include a broader set of firms like insurance companies, you get an even stronger result, because there also you saw an increase in leverage, declining capital ratios. What was really remarkable during this time is if you looked at some of these publicly traded investment banks, a lot of the increase in leverage came about because they were repurchasing stock. They were doing it in the bull market, which goes completely against many of the theories we have about when firms should be repurchasing stock. So a lot of it was really driven by, I suspect, this desire to achieve target levels of ROE. Okay. And that's, by the way, sort of a wide open area of research. I have a working paper that we're still working on with a colleague of mine and another person, where the first time we've got data on what executive compensation bonuses are based on in terms of operating performance. Not the executive comp stuff, but like operating performance bonuses. And what we find is that of all industries, in banking, bonuses are more dependent on ROE than any other industry. So when you look at commercial and investment banks, there's a great deal of emphasis on ROE. From a compensation standpoint, obviously that's going to drive behavior. And look, if I'm being paid on increasing ROE, and I'm earning a lot of profits, and my book equity base is growing, I have very strong incentives to pay that out, even if it means I'm increasing my fragility. Especially during the time when nobody thought that there was any fragility, right? I mean, the world was perfect. So it was sort of somewhat ironic that we reduced capital during a time when it would have been very easy for them to build up that. What is also interesting is that Eric Rosengrantz, the president of the Boston Fed, did a presentation where he showed that if regulators had been paying attention to what was happening in the market in terms of looking at things like the LIBOR-OIS spread, just kind of an indication of both liquidity and all of this risk, that spread was going up, and when it spiked up dramatically, well before the crisis. If regulators had simply stopped dividend payments at the SCFP banks, the ones that received capital infusions from the government, that if they'd done that, it would have conserved something like, I may get the number wrong, but something close to $80 billion in capital, which was roughly the amount of capital the US government infused in these banks when they essentially deal with them. Right? So, we didn't see the pernicious effect of this declining leverage when we should have seen them, right? And the simple steps that have been taken to improve capital ratios and would have really had an enormous impact. Okay. All right, so this idea, there's this interesting question, which is, there's a lot of evidence now that more bank capital is potentially valuable, both from a private as well as social optimality standpoint. But bankers will always resist higher capital requirements. And this is something that I've seen over and over again. I do a lot of work with bank directors, and so just really widespread. Now, the standard banker's view is, I quote from Paul Feider's paper, where he quotes Joseph Ackerman, the CEO of Deutsche Bank, from an interview in 2009, so this is after the crisis. And he says, more equity might increase the stability of banks at the same time, however, it would restrict their ability to provide loans to the rest of the economy. This reduces growth and has negative effects for all. Of course, who wants to reduce growth, right? So, Therefore, end of story, we can't insist on more capital in banking, we just have to live with the consequences. Right? So this is sort of the standard banker's viewpoint. But I'm going to argue that this is pretty easy actually to criticize. We saw the same thing in Europe. The economist in 2014 talked about how under Basel III, with the 3% leverage ratio that was adopted. By the way, banking, the 3% leverage ratio means there's 3% equity as a percentage of total assets. So it's not a risk-weighted ratio. It's assets are not risk-weighted. You're simply just looking at equity over total assets, taking into account off-balance sheet items, right? So 3% doesn't seem dramatically high. But even that was too high for the European banks, right? So they talk about how they got the new rules watered down so they could exclude certain things from the denominator, from the asset base, so that they could get by with less capital, right? And the economist talks about how a rough calculation suggests that these requirements have been loosened just enough to allow the big European banks to pass the 3% test, and that they actually had a calculation that they would have needed to put another 80 to 90 billion euros in capital if in fact the rules had not been worked out. And I still maintain that European banking is in far worse shape than US banking, primarily because they never did the things that we did here, which is under the government's recapitalization program, where the US government basically infused equity into banks because the banks were eager to get the government off its back, because once they infused equity, they put directors on the board of directors. And as a result, they eventually ended up buying out the government. But in the process, we ended up significantly recapitalizing the US banking system. We never did that in Europe. And that's why I submit to you that you're still in far worse shape and much more fragile than US banking is. All right, questions, comments? Yeah.
Could you go back a couple slides?
Yeah.
Because it's a very simple question if you have it up in front of you. Back again, sorry, one more, I think. One more. Okay. Did you separate commercial from investment?
Yeah, so we actually looked at both. The effect is more pronounced in iBanking than it is for commercial banks prior to the crisis, right? So you see similar patterns in both cases.
Oh, the patterns are.
Yeah, qualitatively the patterns are similar. The slope is steeper in iBanking.
Thank you.
Okay. All right, so let me sort of go back to the basics, right? So if you think about, I started my talk by saying that one of the reasons why bank capital structure is not easy to study is that you have to, within the model, if you're building a theoretical model, you've got to provide a rationale for what the bank is doing in the model, right? I mean, why does the bank exist? Something you don't typically do when you're looking at non-financial firms' capital structure decisions. So, what role does capital play in, I'll pick on my paper as well, in Restart 84 and Diamond 84. And in these papers, so Diamond, so the incentive problem, the friction is that you can't observe, the bank cannot observe the cash flows of the projects that the borrowers are investing in with the bank's loan. So you have to do exposed costly state verification, okay? And in my paper with Ramakrishnan, the problem is ex-ante credit screening, right? The bank doesn't know the quality of the borrower's assets, and it has to engage in screening, and each of these papers leads to some implications about how large the bank should be and why it exists. Now, you go back and ask, well, what's the role of capital in these models? And the answer is none, because essentially all theories of banking, like in the case of non-financial firms as well, the reason why you have equity capital is to resolve some kind of friction or incentive problem or asymmetric information problem, right? Now, in both of these papers, the incentive problems are entirely resolved That doesn't mean you get the first best, but they're entirely resolved through other mechanisms, right? So in fact, asymptotically, you approach the first best. So when the intermediary gets infinitely large, in both models, the intermediary is infinitely large, and in the limit, asymptotically, actually the incentive problem completely vanishes, so you approach the first best. So once you do that, of course, you don't need bank equity capital. It's not resolving anything because the problem is fully resolved without relying on bank equity capital. So you can think of these as models of sort of mutual banks with no role for equity capital. All debt finance. Now there have been more recent theories where people have looked a little bit more seriously at what bank capital can do in these models. So the most well-known is the Holmstrom-Tirole paper in the QJ in 1997, and then I'll talk a little bit about the other two papers and the role that capital plays there. So in Holmstrom-Tirole, you have real monitoring by the bank. So the idea is that the borrower can choose among different projects that the bank cannot directly control. So if the bank monitors the borrower, then it can prevent the borrower from choosing sort of a really bad project that has private benefits or perks, which is really not good for social efficiency. And so there's a role for the bank to monitor. And the key in Holmstrom and Tirole is that the bank's monitoring itself is unobservable. So if you're a financier to the bank, you want to be sure the bank actually is doing the monitoring, then you need to provide the bank with incentives to monitor, and equity then provides the bank with enough skin in the game to actually do the monitoring. That's actually good for the borrower as well. So an important implication of the model, and a number of important implications. One is that the financial intermediary must have sufficient capital to justify its existence. Because if it doesn't have enough capital, it's not going to have sufficiently strong incentives to monitor. If it doesn't monitor, then it really has no role to play. You can go directly to the financial market. The other is that capital, so this is one of the really interesting parts of their model, which is that capital in the financial intermediary and capital in the borrower play complementary roles. So what they show is that while monitoring can prevent the borrower from, can induce the borrower, can prevent the borrower from investing in a bad project, it can't really prevent the borrower from investing in a really bad project, okay, which has a lot of private benefits. And that, to rule that project out, you need the borrower to have enough capital. So the borrower must also have skin in the game. So what they show is that there's actually a complementary interaction between capital within the borrower and capital within the bank. Now, keep this in mind in light of the evidence that I gave you earlier, right? Which was what? That we had a correlated increase in leverage in banking as well as among households. So if you take the Holmstrom-Tirole model seriously, we were basically worsening incentive problems, both at the bank level in terms of monitoring and at the household level, right? In terms of how they were going to use the funds that they were raising from banks. And by the way, this paper was published in 1997, right? Well before the crisis, obviously. We don't pay enough attention to, to our own research and understand the implications of that in light of the data that we see in the market. And then the third result that's kind of nice in this paper is that high capital in banking is actually good for the borrower because it expands the borrower's capacity to borrow from non-bank financial sources as well. All right. Any pause here? Questions?
If I could take you
Yeah.
back to something you said earlier about the insolvency, liquidity controversy.
Uh-huh.
I remember there was a paper discussed here a year ago by Rebel Cole or somebody else that basically said that leading up to and during the crisis, non-performing loans as a percentage of total loans were growing asymptotically, and that capital levels remained constant, which suggests A, that prompt corrective action failed, that there was a failure in regulatory oversight, and three, that the accounting numbers as regards capital were lying.
Yeah.
And of course, if the market is not providing liquidity, that's a market function.
Right.
And the people who are believing in the capital numbers, you know, I mean, it seems to me that that's kind of a convenient sort of position to take for the regulators, because you can say that it's a liquidity crisis, not a failure in regulatory oversight.
Right.
And if it's a liquidity crisis, well, it's sort of a market malfunction,
Right.
and the Federal Reserve can be the white knight of
Yeah.
the president.
Yeah. So great questions. I have a couple of things to say, and I'll come back to this a little bit later. So number one, there's a lot of evidence. You can even look at casual evidence, which is look at OCC examiners' reports in the years prior to the crisis. And all of the examiner reports were basically showing a decline in credit screening standards of banks. So this is, the examiners were reporting this in at least 2, 3, 4 years leading up to the crisis. Okay? So regulators were certainly aware that, that lending standards were declining. Right? We have the Amit Seru and co-authors papers showing that with the OTD model, with the regression discontinuity analysis, they show how securitization itself led to a decline in screening quality and standards. We have that evidence. I remember talking to one of my economist friends at the New York Fed about the extent to which they saw some of the early warning signals. They said they did, and they actually tried to push banks informally because there wasn't a change in the regulation, but through job owning and other kinds of pressure to build up capital levels while things were still going well. And of course, they resisted. It's very hard politically for bank regulators to actually impose tougher standards when banks are doing well, which is, of course, precisely what we want to do it, right? But the political argument is, and then you got your friendly senator giving you a call, right, saying, what the hell are you doing, pushing these banks? There's absolutely no evidence of any problems. I was at a conference where the president of the central bank of the Netherlands was there saying that in 06, maybe in 05 or 06, but before the crisis, they asked the Dutch, the major 4 or 5 major Dutch banks, to do a simulation of what would happen if their short-term funding sources dried up for like 3 to 6 months. The banks refused to do it because they said, this is a complete hypothetical, it's a zero probability event. The only reason why you want us to do this is you must have some sinister motive in it. And we're not going to comply and play this game. Right? So when you have this kind of hubris, right, politically, I think for regulators, it's really hard to push for more stringency when there's no evidence that anything's wrong. Of course, by the time the evidence arrives, it's too late. So I think that was part of the problem. Now, the solvency versus liquidity issue. So that's something I discussed pretty extensively in my blue corporate finance studies paper, where you can see that a lot of the initial initiatives of the Fed were based on the belief, just based on what they did, based on the belief this was a market-wide liquidity problem, right? But what happened is, and this is what Taylor and Williams show, is if you look at the credit spreads, right? So the OIS LIBOR spread, not only did that spread not decline, it actually, the spread increased after these liquidity interventions. So clearly, if this was a liquidity crisis, since the spread captures both liquidity and insolvency risk, right, the spread should have gone down significantly. And it wasn't until later in the crisis that the Fed actually realized that this was an insolvency counterparty risk issue. And even though TARP was meant for something totally different, the net effect of what they actually did in the TARP was what you should do if it's an insolvency crisis, right? Which is you want to somehow get more equity into banking and get them to shed bad assets and reduce the opaqueness of bank balance sheets. So that's kind of a long answer to the question, but it's an important question.
Can you talk about the last point about these spillovers? So there are these externalities that.
Which one? Oh, this one? Yeah. Yeah. So this is one of the most interesting points, in my opinion, coming out of the Holmstrom Troll paper, is that their basic argument is that other lenders, other sources of financing, can essentially free ride on the monetary being done by the bank. Right? So if you come to me and you're a borrower, and I, as a bank, have enough capital to convince other lenders that I'm actually monitoring you, that they don't have to engage in also monitoring it. They know that you're a good credit risk. And so I may give you a certain amount of credit, but it also expands your capacity to borrow from other sources, right? So you get these positive spillover effects that not only expand the borrower's ability to borrow from the bank, but also from other sources. This also is important in light of the empirical evidence I showed you earlier, is if you now have a situation where bank capital is falling, so people are not sure anymore that the bank is actually doing the monitoring, and borrower capital is falling, not only are you going to have diminished credit supply from the banking system, but also your ability to borrow from non-banks is going to be diminished. And that's sort of what we saw during the crisis in the credit supply effects. Right? So there's this really interesting paper by Peek and Rosengren in the American Economic Review, where they are very careful about identification of these credit supply effects. And so what they do is they look at the subsidiaries of Japanese banks in the US, and they look at how the decline in the Japanese stock market, which negatively impacted the capital positions of those bank holding companies, and how that spilled over into the US market. And so what they argue is that, look, we can argue that the stock market bubble in Japan had really very little, if any, impact on the US market. So there were no induced demand effects as far as the credit market in the US was concerned. And what they show is that the subs of Japanese banks that had suffered negative capital shocks in Japan reduced their lending in the US. Okay? Interestingly, these borrowers were unable to replace lost credit through other sources. It's very consistent with this. Yeah.
On this third item here, when it says non-bank financing cheaper, it's cheaper than what? Does it mean-
Cheaper than if you didn't have access to the bank.
Okay. Well, okay. That means that the non-bank financer is going to charge you a lower interest rate than they would have if you
And give you cheaper credit, right?
Okay.
So,
They'll still probably charge you more than what the bank is charging.
oh, absolutely, yeah, yeah. So in fact, one of the things that this suggests is that banks still have enormous power over borrowers because credit exclusion from banking can have really serious consequences, okay? Especially for households and small businesses. So it was interesting, this in Colorado, right, it turns out that these shops that sell marijuana, now that it's legal, right, that they so far have been excluded from the banking system because federal banking law doesn't allow banks to basically lend to them. And so it's enormously expensive to even maintain short-term liquidity if you can't have a bank account, right? Because you got to put all that cash in the marijuana shop, and then you're a very tempting target for a lot of bad stuff, right? And so then you need all sorts of sort of things that most small businesses don't worry about, right? Because they have access to the banking system. So credit exclusion can be very costly. Yeah.
And the bank also would still have priority of being paid before the non-bank person, right?
Sorry?
The bank would still have priority to get paid first.
Yeah, absolutely. So I'm lending to you, and then as a bank, and then but my lending to you and the relationship you have with me expands your access to non-bank credit. So when you exclude somebody from the banking system, it's very hard to just replace it with other sources of credit. All right. So this is my paper with Josh Cobalt, where we look at how banks can arise to sort of, in a market in which you have irrational agents, optimistic and pessimistic agents. What we show is that neither the optimist nor the pessimist. So you've got projects, okay? There are some projects that are good, some projects that are bad. You have to engage in some sort of screening to determine which projects are positive NPV. So what happens is if you don't have banks, then the market breaks down because the optimists want to invest everything that they have in projects, but they don't want to screen because they think most projects are good. So it's just a waste of time and money to try and screen projects. The pessimists don't want to screen because they think most projects are bad, so what's the point? It's just a waste of money. So the only guys who want to invest are the rational agents. But they only want to invest if they're screening. And no agent has enough endowment to invest in his own projects. So the rational guy in this model becomes a bank. And they will give their money to the optimists to invest. But then, so that becomes their own capital. And then they get money from the pessimists who are willing to give these optimists money to become banks. So the equilibrium looks like the optimists becoming entrepreneurs, the rational agents becoming banks that put up their own endowment as equity capital. They do screening, and the pessimists are willing to lend to this bank, give it deposits, because the equity capital by the bank is subordinated to their claims, so they have enough safety that they don't worry about the risk in these projects as much as they would if you didn't have a bank. So one of the reasons why Josh and I did this paper is that when I was a PhD student, and the professor would stand up, that was the day of those were the times of efficient markets, right? So nothing could be inefficient, and the professor would put up all the standard assumptions for market efficiency and rationality. And if you're a first year PhD student, you just look at that and say, what the hell is this, right? And so we'd all raise our hands and say, well, nobody's that rational, right? These are just artificial assumptions. And the response was, well, it doesn't matter if there are people who want to smoke $100 bills or throw money in the street for the pigeons, as because they're going to create arbitrage opportunities for the rational guys, and they'll form institutions, and they'll basically exploit those opportunities, so these irrational guys will have no price impact. So the whole argument was based on somehow institutions arising to get rid of the impact of irrational agents. But I've never seen that argument actually formalized by anybody, right? It was just sort of angry. So we said, well, let's see if we can formalize it and show how these banks can act as a beliefs bridge between two sets of irrational agents. So anyway, the important thing is that without intermediation, nobody invests. And intermediation is impossible without enough bank capital, because you need the bank to have enough skin in the game to provide enough of a cushion for the pessimistic investors to invest in the bank. So you get more lending by banks and more investment when banks have more capital. All right, I'm actually going to skip this in the interest of time. And get to, so there's a lot of theoretical, there's a very strong theoretical argument that you can make, and I would submit to you a lot of empirical evidence that if you have higher bank capital, you get more stability, you get more investment, you get more growth. Okay. Bankers, of course, don't agree, but even within academia, we don't quite agree on this, right? So we have two somewhat divergent views. So this is 2 series of Diamond Rajan papers where Raghu talks about the disciplining role of bank leverage. So these are models in which you don't have deposit insurance and leverage, as in the Hart and Moore papers, and Grossman and Hart papers, as a disciplining role to play. So they argue that, look, we're just going to have leverage for market discipline, and that's going to give rise to fragility. And then there is the Admati DiMaggio Hedley Flighter argument that equity capital in banking is really not expensive, and we need a lot more equity in banking. So I think even within academia, it's fair to say that we haven't quite come to a consensus on what the role of bank capital is. Okay, so just to make that point clear. Now, I have this review paper in the Annual Review of Financial Economics, in which I talk about all of the literature, review about 150 papers, on bank capital and financial stability. Is there an economic trade-off, and what is the trade-off? And so the 3 questions that look at in this paper: will higher levels of capital in banking lead to less lending and less liquidity creation by banks? This is the claim that bankers make, right? Will requiring banks to keep more capital increase funding costs for banks and diminish their values? This is again another argument that bankers make. And then what are the systemic risk implications of higher capital in banking? So now one thing that I just want to make clear is you have to distinguish between higher bank capital and higher bank capital requirements. Those are 2 different things, okay? So will higher levels of capital in banking lead to lower lending and less liquidity creation? So I mentioned the paper by Amiyatosh Purnanandam in the RFS. That basically shows that banks that had less capital and which were securitizing in the originate distribute model, they originated mortgages of poorer quality. So this is very consistent with the theoretical argument that higher capital in banking leads to better screening for borrowers by banks. So this was sort of a follow-up on the, on Amit Sayur's paper in the QJE on how the OTD model dilutes screening incentives for banks and securitization. So that's, so here at least the evidence seems to be if you have more capital, banks are going to screen more carefully. Okay. So it goes back to the earlier discussion that we had, why were banks not responding to the declining asset quality of project? What is the effect of bank capital on lending? And here I'm going to distinguish between higher capital and higher capital requirements. So when it comes to the effect of bank capital on lending, I mentioned the Peak and Rosenberg paper, right, earlier. And they show that the 89 to 92 Japanese stock market crash caused Japanese bank capital levels to fall. This was an exogenous negative shock to the capital of US branches. And they show lower lending due to the credit supply shock. And this reduction in lending by the Japanese banks was not made up by increased lending by US banks that were not affected. At least not enough. So, simple conclusion, when capital levels in banking fall, lending falls. Okay. And I could cite a lot of other empirical papers, I could cite other theoretical papers that are all consistent with this conclusion. So very simple. Level of lending declines when the level of capital in banking falls. Now, a lot of times the level of capital in banking is falling because of some negative shock, right? So that's why it's important to separate the supply and demand effects. Now, what about the effect of bank capital on liquidity creation? So there is this paper by Berger and Bowman in the RFS, which creates an empirical measure of liquidity creation that takes into account on-balance sheet and off-balance sheet items. And they find that for large banks in the US, the relationship is positive. So more capital in banking leads to more liquidity creation. Okay. For small banks, it's the opposite. The large banks in their sample account for about 81% of the liquidity creation in the US banking sector. So again, here the evidence does seem to be that higher capital leads to more liquidity creation. There's a series of papers by Calabrese. So Charlie's papers basically examine the effect of bank capital on their competitive position and survival. And the bottom line of these papers is that banks with higher capital seem to have a competitive advantage in both the loan markets and in the deposit markets, even with insured deposits. A more recent paper by Berger and Bowman in the JFE examines the effect of capital on a bank's probability of surviving a crisis. So they don't just look at the last crisis, they look at a number of previous crises and its market share, and what they find is that the higher capital banks have a higher probability of crisis survival and they gain market share as a result of the crisis. So there's sort of a reallocation of assets within the industry from the higher capital banks to the lower capital banks. By the way, there is a recent paper by David Tesmar and two co-authors, which I know because I was session chair for this paper at the FDIC conference last month. There's a very interesting paper that looks at the market. So they asked this question, was this a liquidity crisis or an insolvency crisis? And they look at wholesale funding in Europe, right? So these are jumbo CDs. So it's not the insured small deposits, but jumbo CDs. And what they find is that the crisis had a very interesting effect, is that the strong banks, the ones that had high capital, actually increased their wholesale funding during the crisis. And the weak banks experienced a substantial decrease. So their point is, this wasn't some market-wide liquidity freeze, where all banks experienced diminished access to the wholesale funding market in Europe. Instead, what the crisis did is it forced a reallocation within the industry from the really strong banks to the weak banks. Okay? So I see sort of this evidence as being similar to that in a very different context. The crisis induces a reallocation. Let me stop here, catch my breath. Questions? Yeah, Chester.
So on that reallocation, I guess does that have to do with the ability of some institutions not to take on more risk and therefore substitution to the other institutions?
Yes, let me see if I remember the details of that paper. So what they find is that, what do they find that so it's very interesting. What they find is that there was actually a causal impact. No, what they find is that the weaker banks actually found access to the wholesale funding market just much more expensive. Okay. The stronger banks didn't find much of an increase in the cost of access. So somehow, where the access cost may have been like this, it kind of went like this during the crisis. And then they also show that the post-crisis performance of the banks that experienced diminished access to the wholesale funding market actually declined relative to pre-crisis performance. And you didn't see the same decline for the banks that had increased access. So kind of the gap, essentially what the crisis did is both in terms of access to funding as well as post-crisis asset performance, it just widened the gap between the strong and the weak. It's just sort of intuitive, but it's still interesting to see. Yeah.
And these are the CDs that are right out guaranteed by the FDIC, right?
No, these are European banks.
Oh, Europe.
So European, they look at the uninsured, so wholesale funding, the LOC.
I was thinking about the relative interest rates that were being paid by the good banks and the bad banks.
Yeah, well, I mean, the deposit insurance, you're not on the core deposits, you don't see it. Okay. So the second question is, will increasing capital requirements increase funding costs for banks and diminish their values? Now I had a paper back in '96 in the JF, and A.R. Cavaliers and Wolodak have a paper forthcoming in the JF, so we can already publish it. We're essentially similar evidence that, what I found is that when we switched for the first time to risk-based capital in Basel I, that banks actually reduced their lending because they had a phase-in period for new capital requirements, and for government securities, you had the zero risk weight, but for loans, you had this 100% risk weight. So in the short run, what banks did is they shifted away from lending, putting everything in treasuries. Meanwhile, the Fed was pumping a lot of liquidity, the banking system, if you remember, the early 90s, before we came out of it. And basically, banks were taking all that liquidity and putting it in T-bonds and T-bills instead of lending. And that was because we changed the structure of capital requirements. So in the short run, when you change the nature of capital requirements, you increase them. There is an adjustment period as banks rarely issue new equity to meet higher capital requirements, especially if they have time, is you do it by cutting back on dividends and retaining more. And it takes a while for that capital to build up. So you'll see some transitional effects in terms of lower lending. There's a paper by Hansen, Kashyap, and Stein, which looks at the terms of lending. What they find is that if you increase capital requirements by 10 percentage points, bank loan rates would increase by only 25 to 45 basis points. Now, we can argue about whether that's a big or a small effect. I don't think that's a big effect. My colleague, Asaf Manera, and Ronnie Kissen have this interesting paper forthcoming in the RFS, where they look at if you increase Tier 1 capital by 10 percentage points, they show that annual profits of the average bank will decline by only 4%. So again, not a big effect. The other question related to this is what's the relationship between bank capital and value? And this is something that Hamid Mehra and I looked at in our RFS paper. And we essentially, so the Miller paper that I told you about earlier in '95, basically Miller's conclusion was, hey, there's absolutely no reason why Miller doesn't apply to banks, right? There's nothing that's special about banks. Capital structure doesn't matter. And well, this paper, and of course bankers would argue the opposite, that more equity capital means lower value of the bank. And so what we find is that neither Miller nor the bankers are right. We actually find the total bank value and the bank's equity capital are actually positively correlated in the cross-section. And we look at various components of bank value in the acquisitions context and show that these are all positively related to bank capital as well. So at least there's evidence that capital doesn't hurt the values of banks. And then finally, what are the systemic risk implications of higher capital in banking? Very little work on this. Okay, so this research is basically in its infancy. And by the way, this is a challenge, right? Because when academic researchers talk to regulators, we talk in we're theorists, we talk in qualitative terms, right? Well, higher bank capital is good. And so I say, well, how much more? Right? And then we say, well, not so much that you do this, and not so little that you do that. Well, okay, that doesn't tell me anything about how much, right? But if you're a regulator, you're really interested in calibration. So now we're beginning to see papers being written where people are actually building structural models and going out and calibrating, what these effects would be. And the results are actually quite interesting. So there's a paper in the Economic Journal by Miles and co-authors where they have a structural model in which they take into account the expected benefit of bank capital in reducing the probability of a crisis, as well as the tax benefits of bank debt. Okay, so this is the only benefit that they have. So in a sense, it's limited. They estimate that the optimal capital requirement should be 20% of risk-weighted assets, not 8. Okay, and this translates to a leverage ratio of 7 to 10%. To put this in perspective, under Basel III, the leverage ratio is 3. U.S. bank regulators, the Fed, has adopted 5. Right, so this is twice what the higher U.S. bank leverage ratio is. Right, so this is now. I actually think that the optimal leverage ratio should be even higher, but by God, I'd take 10% if I can get it. I mean, we would be so much better off if we did that. So let me pause here. Questions, comments?
So what do you think of 100% equity funded banking system?
No, I don't buy that because that's just that's still the whole. You can view that as sort of one version of narrow banking, or and I'm not a proponent of it. First of all, I don't think it's practically realistic. So we can engage in all sorts of interesting conversations over a glass of wine about what about this or what. I don't think it's practically realistic. I've not talked to a single regulator who takes that seriously. Right? So that's one. Secondly, I don't think it's even theoretically sound. I mean, you think about what banks do, right? I mean, they create liquidity, they take in deposits. The banks are one of the most important places to just store stuff, right? And sort of warehouse. In fact, if you think about the origins of banking, banks began as warehouses for commodities. Whether it was gold or it was grain, and then they evolved into commodity banks, right? So having a place where you can actually go and deposit short-term liquidity, and having an institution that does that and then creates liquidity, where debt financing is a big part of it, I think is a very important part of what a bank does, right? So I think you need that. Now the question is how much equity. If you look at, so the best way to look at that, I think, is if you want calibration, right? Not the best way, but one sort of crude way, but helpful way to look at the calibration issue is to look at what bank capital ratios were before we had deposit insurance in the U.S., right? It's a very simple exercise. You go back and look at these banks, and they had 20 to 30% capital ratios. So the analog of that would be the leverage ratio today, right? Just to put that in perspective, we did not have deposit insurance. Banks voluntarily would, and by the way, this was at a time when we had no formal capital regulation. Formal capital regulation in banking in the U.S. didn't really arrive until the 1980s. Okay, so this was banks voluntarily doing it. You look at state-chartered banks, there are very few of them that have no deposit insurance. But you look at their capital ratios, and they're sort of not that different, right? So if you want one calibration signal, that's now. That doesn't mean that with all of the safety nets and the central bank and all that, we should insist on leverage ratios that high for all banks. I'm not suggesting that, but even there, we don't have 90% equity. So and there are tax benefits to that. So there's an interesting paper by Shepens that in Belgium they had a very interesting experiment in '06 where they allowed all firms to deduct a certain percentage of dividends as an expense for tax purposes. So just like interest, this is a mechanical formula based on the yield on most you get there. And so he looks at what banks did in response to that, and they all increase their capital ratios voluntarily. Right? So I think banks will do a lot voluntarily if we change the structure of the system, but I mean, just taxes alone would argue against it. Right? By the way, I suggested this to some people in the Fed. Why don't we do something similar to Belgium and give banks a break on the taxability of dividends? And they said they'd actually had a discussion with the IRS, and the IRS couldn't really do it. Because they don't want to do it for all firms. That's too expensive. And can you imagine the political ramifications of just doing it for banks in this environment? Of course, banks are responsible for all of the evils that we experience. It just wasn't feasible. But I still think what they did in Belgium was an interesting experiment. So let me talk in the few minutes that I have about why bankers are averse to capital. I don't think it's one source. I think tax benefits of debt that I talked about is one reason. By the way, in banking, this is even more important because banks have a lot of close competitors that are actually tax exempt, right? So they have a competitive disadvantage: credit funds, mutual funds, securitization vehicles. And so banks may try to minimize their taxes too by pumping up their leverage. I mentioned the Shepard's paper, which shows that banks do respond to changes in the tax code. So that's one advantage. The other is the old argument by Bob Burton that deposit insurance is isomorphic to a put option, and the value of the put goes up if the bank reduces its capital. So that's, now empirically what people have found is that this effect is really strong only close to the insolvency boundary, that it doesn't look like across the entire range of capital ratios taking the put effect into account. The other is the point I mentioned earlier, which is ROE. And so we're still working on this paper, but if compensation is based on ROE, and there's a paper still to be written on why banks are so much more interested in basing executive compensation on ROE, I don't know the answer to that. But given that that's true in the data, clearly that creates incentives for banks to maximize leverage. Also, there's a funding cost advantage. So this is really very interesting, right? So Flighter, in his paper notes, he quotes Moody's and S&P. He's basically saying that they provide a 2 to 3 notch ratings advantage to the uninsured debt of financial institutions that have deposit insurance and other safety nets. Which means that they're implicitly pricing, they're not explicitly pricing implicit guarantees, which are not really hard guarantees, right? But they're taking into account the possibility of a bailout. So that would obviously also encourage financial institutions to have more leverage. I think debt overhang may be one of the best explanations. You know, the old Stu Myers argument for why a firm may not, this is for all firms, not just banks, but I think it really applies to banks. Because when you think about the Myers argument for debt overhang, we're talking about institutions with 95% debt on the balance sheet. I mean, you know, if you're ever going to have overhang, it's in these situations, right? So the incentive to infuse equity in these situations is going to be pretty weak. And then I think politics, right? So if you read I highly recommend this book by Charlie Calaveras and Haber on politics and banking, which is, their whole argument is that banking is unsustainable without political support, at least the way we visualize the banking system. And so banking and politics have always been mixed. And that may be a great argument for why banks don't really want to commit a lot of equity capital to banking. So anyway, those are some of the reasons why banks are averse to capital. So let me talk about some, I'm going to get into the open questions. But before I get to the questions, are there any questions? Comments? Yes?
So getting back to the slides that you sent after calibration, setting the higher capital requirements for banks. So is it enough to just set the higher capital requirements without requiring them to manage or mandatory equity instruments? Because it creates some misaligned incentives for managers to just meet those capital requirements without considering cash.
So when you say actions, what do you have in mind?
So for example, getting back to his opinion about like increasing the non-performing loans and somehow, managing.
Yeah, that's sort of timely recognition of losses and, how does it impact capital? Actually, going back to that, one of the things, one of the mentions is that most of the empirical studies have found that regulatory capital ratios are useless in predicting anything about the future, about how the bank will do, right? But apart from that, so in fact there you're just better off using like straight, equity over total assets as opposed to the regulatory risk-weighted ratios which they can roll out of the edge. No, yeah, obviously you have to have things like timely recognition of losses and those sorts of things, because if you don't do that, then and everything in banking is based on book equity, right? And so if you don't do that, then the book equity is going to be a gross misrepresentation of what the economic value of the bank is. I mean, this is a problem that goes all the way back to the S&L crisis, right? Where we had institutions that had positive book equity and economic net worth that was usually negative. And the institutions realized it, and therefore they took excessive risk. In fact, this is still one of our best examples of moral hazard practice, right? So no, absolutely, we still, you have to worry about, it's not just capital, it's regulatory forbearance. It's, whether you bail banks out. So you saw what happened recently with Deutsche Bank, right? The German government actually explicitly came out and said, we are not going to bail them out, right? Now, they're actually credible because they passed a law that can't do it. So it has to, bailouts have a very distortionary effect. The flight order evidence that I showed you earlier is because rating agencies expect bailouts. And when we talk about bailouts, it's not bailing out the equity holders. It's bailing out the sub-debt holders, the uninsured creditors. Because that's what the bond investors care about, right? So if you have those sorts of things, then you're going to, in effect, diminish the effect of higher capital. So it can't just be done in isolation. So here are the open questions that I hope people in this room will find interesting to study. One is, what's the optimal level of capital requirements? As I said, regulators are interested in this, right? What's the number? Give me a number, not just qualitative trade-offs. So we need more quantitative calibrations and models that capture all the key trade-offs, but also are attentive to the micro foundations for why banks exist. What are the allocation consequences of higher bank capital, right? So if bank capital goes up, is it that everybody is equally better off, or are there different allocation consequences? Are there redistributive effects, right? And at least some of the existing empirical evidence suggests that there are significant redistributive effects. So we need to understand what these are. This is something that I think is sorely needed, is we don't really have any theories of banking, at least micro theories of, that microfound why banks exist, that have politics integrated into them. And yet, if you read the Calamere-Saber book, it's fascinating. I mean, they have a 500, 600-year account of how politics has influenced banking, not just in the US, but in most countries in the world. And I think this is something that we have to take seriously. And think about theories of the integration of politics into banking, and also look at clever ways to design empirical studies that we use. What are the linkages, theoretical linkages between bank capital, consumer leverage, liquidity creation, and the labor market? Right, so, we don't have, at least in the microeconomics of banking, we don't really have a lot of research that looks at labor market outcomes and what's happening in the banking sector. So the Mian Sufi work is kind of at the vanguard of this research, right, where they are now beginning to worry a lot about what's happening on household balance sheets and how it actually spills over into how it interacts with what's happening in banking and how it actually affects labor market outcomes, like unemployment, that economists are so interested in. So these labor and capital market linkages, I think, are really important to study. and I hope we have more of this. The people in macro are of course worried about this, but I'm thinking about this more from a micro banking perspective. Because the macro papers are sort of, they're not that attentive to the micro foundations of the bank itself. And then, this I mentioned just in passing, which is, how do we theorize bank culture, right? So culture is not a term that economists use a lot. And about 3 years ago, I got a call from the Federal Reserve Bank of New York, and their president, Dudley, was talking about how important bank culture is as a way to think about the behavior of banks. And of course, the economists said, we have no idea what that means. So, can you come here and let's have a conversation about what do we mean by corporate culture in banking, and particularly what might be the implications of that for the possibility for prudential regulation. So, since then, the New York Fed has organized a whole series of conferences on this. So, how do you theorize bank culture? And how do you even think about it? What is it? Right? And what is the impact of that on behavior in banking? And then there are a lot of interesting empirical questions that I think are still left on the table to answer, which is, how does bank capital affect financial crises? What's the causal impact, right? So again, identification is really important. What's the interaction between bank capital, regulatory safety nets, and the likelihood of financial crises? How do safety nets affect the speed and quality of post-crisis recoveries? So there is some evidence by Ashley Demerich-Kunt and her co-authors of the World Bank, which finds that in countries in which you have more extensive safety nets, the incidence of the financial crisis was worse, and the post-crisis recovery was the slowest. But I think this is something that we'd like to know a lot more about. How does the level of bank capital, not just the changes in capital requirements, affect real outcomes, right? GDP growth, unemployment, and so on. I have a working paper with two co-authors, two colleagues of mine in Washington, where we actually link credit and labor markets, and we find that higher consumer leverage leads to lower research in the labor market by households and higher unemployment. There isn't a lot of empirical evidence on this. There's one paper by Asaf Bernstein, who was in the job market last year from MIT, which essentially documents some evidence that's consistent with this, but still at a very early stage, and this would be a fascinating question to know the answer to. As I mentioned before, was this a liquidity crisis or was this an insolvency crisis? Very important to be able to distinguish, and then the interaction between bank and consumer leverage. So I think these are all very interesting questions. Not an exhaustive list, but still an interesting set of questions to look at. So to conclude, bank debt might have some benefits. Empirically, these benefits have been elusive. But higher bank leverage seems to lead to higher systemic risk, higher sovereign indebtedness with negative productivity and growth consequences. There's a paper by Vermacharya that basically documents that a higher probability of crisis with devastating economic consequences. So we know all of the negative consequences of high bank leverage, whereas the benefits of banks with deposit insurance. For banks, so if you have banks with deposit insurance, what's the point of not having more capital? Those benefits we don't know yet. So, but I think you can't just go to regulators and say, let's increase leverage ratios to 20% or 14%, 10%. That's not going to fly. So how do you creatively think about, from a research standpoint, buttressing the argument that we need more capital for more stability? So anyway, I'm done. Questions? I'm happy to take any questions about what I've talked about, big picture, small picture.
If we want to talk about regulatory standards in consumer lending that have gone on.
Yeah.
Right? So I haven't seen a lot of papers. So on the one hand, it seems like monetary policy was trying to relax constraints towards lending. On the other side, call it the fiscal side of the picture, was increasing standards that lenders had to pass through before extending loans. So it seems
You mean post-crisis?
Post-crisis.
Yeah.
So this is on the recovery side.
Yeah.
So I'm wondering why, so things that led to the crisis, sort of you reverse them.
Yeah.
Should accelerate.
So theoretically, what in the paper that I mentioned with PSMT and Donaldson, what we find is that if you want, so our main result is that high consumer leverage actually leads to higher unemployment in the labor market. Okay? And so we have a labor search model. What we show is that when consumers are more highly indebted, they tend to search more actively in labor submarkets where wages are high. And employers respond to that. But the high-wage jobs actually have lower probabilities of people getting hired. So unemployment endogenously rises because labor participation in the search for jobs is distorted by the leverage gap. So at $50,000 in debt, I'm not interested in a $55,000 job, right? Where I'm working my tail off to make $5,000 and the rest of it is going to pay my bank loan. So I'm going to look for a $90,000 job, even though the probability of finding it may be much lower. And so that distorts the labor market and leads to unemployment. The Bernstein evidence basically shows that the more highly indebted consumers reduce the labor market surge, but most of the effect was at the expense of market. So it's not that I was working less hard in the job that I had, I just wouldn't look for a second job, right, if I had a lot of debt. So there is that distorted effect of consumer leverage. So in our paper, the loan-to-value ratios actually make sense. So you could argue that there is a rationale for limiting the ability of consumers to borrow more and sort of asking for more skin in the game and so on. But you know what happens in every crisis is you go from one extreme to the other, right? So you've sort of gone from having no regulation there to sort of now having excessively onerous regulation. I know that personally. I just bought a house and went through the process of getting a mortgage. And my God, it's painful, right? I mean, like they want to know what every deposit in my bank account was for, right? Wow, what was this deposit for? None of your business, right? But no, they want to know every deposit because they want to know if you know, where'd you get that money from? So you can make that process so onerous that you can even have sort of demand effects because of these very onerous requirements. So eventually, you know, we'll settle into some sort of equilibrium.
Did you get a subprime one?
I'm sorry? Yeah. No, this was, so what makes this really interesting is that the price of the house roughly equal to my annual income, right? So you would think that for a person with tenure, that wouldn't be an excessively risky loan, right? That didn't change anything. Yeah.
Add on to that, I'm getting a home equity. My wife and I have no mortgage debt of any sort.
Yeah.
I'm getting a home equity of 10% of the value of the condo we live in. And I am being required to send them every month my most recent paycheck.
Oh, yeah.
Been tenured probably longer than you've been.
Yeah.